Opening in progress.
Welcome. Thank you for joining us. This is Stone Ridge Partners, part of our business briefs. This is a learning session on why to sell now. I'm joined today with my partner and long-term friend, Brian Brenderman. Brian, welcome.
Thanks, Rich.
Maybe these are 10 to 15 minute segments, so we're going to jump right into it. Brian, why don't you introduce yourself a little bit? First of all, I'm the CEO and partner with Brian here at Stone Ridge Partners. Brian is one of our, actually, you've been here longer than anybody else. Senior partners. Stone Ridge is 21 years old. We're doing dozens of deals a year in home care, hospice, home health, and behavioral health. Last year, we probably did in excess of 40 transactions that were closed in that space. So it makes us one of the probably the largest in that space, business brokerage and investment banking type work. So Brian is one of my partners, like I said, one of my dear friends, and also one of our most active in this space. So Brian, with that, why don't you introduce yourself a little bit and give us some opening comments on why we should be selling today?
Sure. Thanks, Rich. I appreciate it. Yeah, I do. I think this is a timely approach to, and a good time to talk about this. I think the questions that we get a lot of times are, when's the best time to think about selling my business? And I always say, well, that'd be the day you started it. But if you didn't do it then today is a good time. And sometimes it's when there's a lot of activity and a lot of active buyers. And I think that's the environment we're seeing now. Been in this business a long time. Prior to Stone Ridge, I was in corporate development. Spent a lot of time buying these businesses before I switched to the other side of the table and started selling them and helping people, assisting people with their exit strategies. So I think that gives Stone Ridge a pretty unique perspective, having been on both sides of the table. So I think that we're in a really interesting time right now, and all indications to me are pointing towards maybe if you've been thinking about how to plan for your business or an exit strategy, now is the time to really seriously consider what that looks like. So.
Great. So Brian, why don't we talk about a couple different things? Why don't we tackle two? First, the buyers. There's been a lot of new buyers, different types of buyers in the market, and the volume of buyers have gone up, and then the types of buyers, and also kind of throw in valuations, because we talk about it. We sound like a broken record all the time, but valuations are high, and they remain robust.
The valuations are very robust, which is, again, maybe the best time to think about selling your business is when somebody with a whole lot of money wants to buy it. But right now, we're historically, we've had a situation where there have been a number of strategic buyers who really have kind of consolidated the market. We are now seeing a tremendous amount of capital that people are looking to put into play in the space, in post-acute specifically, that has opened up the door to buyers that haven't historically bought a lot of these companies, but are now. And they're aggregators. They're paying premiums for platform businesses, and really traditionally platform businesses were the very, very large companies, and people bought those and then aggregated smaller businesses to put with those, adopting sort of a blended multiple strategy. So they paid a premium for the larger companies and then less for the smaller companies, but over the course of consolidating that, it all sort of worked. Now platforms are much smaller companies, so even the mid-sized companies are qualifying for very, very, what I would call premium valuations, at least historically. So and because people see the ability to aggregate those with smaller providers, and I think there's a real opportunity there for sort of the small to mid-size operator who maybe didn't have a big pool of buyers traditionally, but now has a lot bigger pool to pull from as far as potential buyers are concerned.
Okay, so Brian, just an example of that, and I'm sure you're the same way. I used to get one call a week, 4 or 5 a month of what I would call new buyers, private equity groups trying to enter the space. And these are big private equity companies that may do a lot of other stuff, but they want to get into home care and home health and hospice. Today, I'm getting multiples a day, right? I mean, it's not the change in what we're talking about is dramatic in the interest in the market, and part of that is people realizing what the industry's been saying about it's a preferred area for the providers, preferred area for the recipients. The payers like it for the cost, the hospital system. So healthcare in general has realized this is the space to be in. COVID has sped that up, and the market the buyers of companies have realized this is the space they want to be in. So I'm sure your phone's ringing off the hook like mine is. Valuations, it's always a tough question, and I know it puts us on the spot, but we always get asked this when we have a live audience. The range is the historical range for, I would say, sub $1 million EBITDA companies' earnings of $1 million or less, not revenue, earnings, are kind of unchanged. They may have moved up a little bit. Instead of 3 to 5, they're 4 to 6. Would you agree with that?
I agree with that.
Now, granted, everything's geography specific, CON specific, but size means a lot. When you start getting above $1 million, then you really start getting those premium. This is $1 million on earnings, what we call EBITDA, not revenue. You start going above that, and it gets really exciting. And today, it's as high as it's ever been. So, I don't know if you want to add anything about the valuation. I know it's a really hard question. Each company's worth its own thing because they're all unique.
It is company specific, but I will say that having a lot more competition in the market has driven up valuations significantly. And I think it's also increased the willingness on the buyer's perspective to entertain alternative deal structures. So historically, when strategic acquirers were the exit strategy of choice because they had synergies, now there are companies like you talked about, Rich, the private equity groups that are extremely competitive and can meet those prices despite the fact that they may or may not have any synergies because they see a longer term play, but opens up a lot of doors for alternative structures. So we're seeing now people who say, hey, listen, you know what, I've been in this business a long time. I'd like to take some chips off the table. Maybe I'd like to roll over some equity and continue to build this company, but we'll do it with somebody else's money and maybe get a second bite at the apple down the road. And that's over time. Historically, that's not been something strategic acquirers were ever really interested in entertaining. And the new pool of buyers are very interested in keeping people in the game and keeping them involved and making sure that you've got something at risk as well. But still, it allows you to take some chips off the table, realize the value that what you created, and also maybe potentially cash out, have a second exit if and when the liquidity event happens on their end. So,
yeah, those are usually what 80-20, 90-10. I mean, they can be all over the board, but they're usually, you still get majority of your cash today. And you have buyers that are still buying 100%, but that isn't new buyers to the table, much more willing to do that. And it's another option when you're looking to sell and not quite ready to get out. What about a couple other headwinds and tailwinds? People have been talking about taxes, and
we have a tremendous amount of steam. People are scared to death of what's going to happen with the tax situation. We've got a lot of folks pushing to close before year end. So I think there's going to be a tremendous amount of volume and transactions before year end this year. I think the consensus is it's not going to get any better. So, and Rich, you can comment on that a little bit as well. So,
yeah, I mean, it's kind of like a crystal ball on the taxes. We have basically a 20% capital gains rate today on these assets that when you sell them, that number is going to go up, right? The proposal is 40%. I think reading the tea leaves, so to speak, and what people are saying, they think it's going to be 30, and it's probably going to be January 1st of 2022. So there is a window left. If you wanted to sell, you could do it this year and pretty much ensure that you'd be at the lower capital gains rates. And those rates, when they change, tax policy doesn't. We've had a few clients say, "Well, I'll just wait it out." Capital gains rates started going down in the 80s, and they've gone down every decade since. And that's been 40 years. Capital tax policy doesn't change quickly. It's not just because the other party takes over the Congress, both houses, or even the presidency. It's hard to get tax policy through, and it just doesn't change very fast. And the thinking is they will get it through this time, and there'll be a raise, and it'll last for it can be changed tomorrow, but more than likely tax policy usually lasts 5, 10, 15, 20 years. Okay, any other headwinds?
I think too that just if you look at the market circumstances in general, particularly as it relates to traditional Medicare home health, and even to maybe a lesser extent, but it's not insignificant, Medicaid personal care in very specific states. The managed care penetration is a real conversation. So there's going to be consolidation. Managed care environments favor larger providers. And so as a small to mid-sized provider, you're going to be disadvantaged in a predominantly managed care environment. As that increases, becoming part of a larger system, I think there's some benefits there, not just as a provider, but as a strategic play. I think there's some advantages to becoming part of a larger package of services. And we just quit talking about that during COVID because it kind of stopped. But I think we'll start to see that the managed care penetration continue to increase as we go forward here in a post-COVID environment. So
I agree with you, Brian. And when we got in this business a long time ago, people wanted size. They wanted an office, and they wanted exposure to California and New York and Kentucky and Florida and Texas. Today, it's all about exposure within your MSA, right? The size matters where you provide the service. Healthcare is local. And as managed care becomes a bigger piece of what they're doing in these markets, the medium to smaller size providers are really disadvantaged to what they can offer. Brian, closing comments. We're wrapping up. This time flies by on these short little ones, but people are always welcome to reach out. We give away a lot of free advice, and we want to talk to anybody who wants to talk to us.
Advice from me is free and worth it. So.
Okay, Brian, I appreciate your time, and thank you for doing this. And thank you for everybody who's watching. Take care. Bye-bye.